I'll set my timer. As always, tax has got left last. I think that's probably one of the lessons for life, is that everybody runs around, makes their decisions on all the commercial things, and then decides, I can't get my timer to work. Right. Who am I? I'm Anne-Maree Dunn. I'm a chartered accountant and a chartered tax advisor. I've got lots and lots of years of experience looking after lots of owner-managed businesses. A large number of those are buy-to-let investors or property owners or property developers. So over the years, I've seen how tax can really impact when changes happen. Usually we're consulted or people come to us when they're about to make decisions, buying, selling, changes in the family, gifts, those sorts of things. So I'm here today to give you the benefit of my experience of what things can cause problems, what things you can do to look ahead. And I've only got 10 minutes, so I'm going to really focus on a few simple things. The first thing is, if you're in the buy-to-let market, you need to stay up to date with tax changes. You probably all know the Chancellor of the Exchequer loves you. Every year, every budget, since 2012, I've seen 3 or 4 major changes a year that impact the financials and the future of buy-to-let investors. I'll talk about a few of the ones that I think get missed or are quite important. The second one is, and everyone's mentioned it, structure. That's probably the most common query we get. Should I buy individually? Should I buy in a company? Structure is important at one point, but it's something you need to review really regularly and think about and keep reassessing, because people's lives and needs change. And the final one, which is topic of the moment really, and a lot is happening with large portfolio investors, is incorporation right. By all means, it's not right for everybody, and it's not without technicalities and complexities, so I'll cover that very briefly as well. So a couple of quick tips on what's topical. A lot of people and a lot of our clients get into buy-to-let to start with because they actually let out a home that they have previously lived in, or buy a home for children at university and then keep it on and they live in it. So it's just a quick top tip. This is an area that's been tweaked and tweaked. You used to get the period you lived plus the final 36 years of ownership tax-free, got cut to 18 months. From the 6th of April 2020, that's getting cut again to just 9 months, and a very valuable lettings relief that can exempt £40,000 of gain is disappearing. So if you are umming and ahhing, is this the right time to sell it? I'm in the middle of trying to sell. If you can get it done before the 5th of April, some of the calculations we've done for clients, the tax is 3 times higher if it's not completed before the 5th of April. And the letting exemption, which will disappear, is worth £11,500 alone at current CGT rates. So if you're in that position and you're in the middle of thinking about selling or umming and ahhing, do the numbers. You might decide it's the right time. The tax will help. The other area that's had huge complexity and huge changes is non-resident landlords. So if you're advising investors who are non-resident, this is a really complex area now. So I'm just giving a few little tips. Make sure people get their properties valued. If they've got a portfolio they've held for a while, you don't want to be in the position 10 years down the line trying to work out. All non-residents are now individuals subject to capital gains tax on the growth in value since 2015. And then we've got corporate landlords, 2019, and also any transactions in shares in corporate landlords links to the underlying property. So make sure you get your values done and you keep your records. The second one is actually keep your records as you go along. There's nothing worse than when you are about to sell your property, you have to do a capital gains tax return within 30 days of sale and submit that. And if you're not registered for self-assessment, then you need to pay your tax within 30 days. So making sure at least you keep a good record of improvements you've made to the building, all the costs you've incurred, not just the original costs, the stamp duty, land tax, the professional fees, work that you're doing to improve it as you go along. Capital allowances, if you have a commercial building, make sure you're capturing those sort of reliefs and recording them. That will be required on transfer and sale. And then if you are a corporate non-resident landlord, from the 5th of April 2020, you're going to move from the self-assessment regime, which is just about paying income tax, to corporation tax, a far more regulated regime. You're going to need to incur a lot more compliance costs to deal with corporation tax returns, company accounts submission, understanding how those rules impact you. For some it won't impact, but for others it's going to be really important. The timing of when tax is paid will change. If you're a large portfolio with over £2 million in interest paid, you will have some restrictions on mortgage interest, which you don't have now. So just getting your head round what you need to do and be ready for. The other one that we see time and time again that's really misunderstood is what's called ATED, Annual Tax on Envelope Dwellings. And this is a tax regime that's been around since 2012, but now impacts anyone who owns a residential property held in a company or in an LLP or partnership with a corporate member with a value over £500,000. That value was pegged at 2017, or if it's a purchase date since, and goes up every 5 years. If you've got a residential dwelling, single dwelling in a block of flats, or single dwelling worth more than 500,000, this affects you. There are really, really penal penalties and daily penalties. For one client, it's about $1,500, $1,600 a year fine if you haven't got things up to date and bringing things up to date. Only those who let people connected, so if you live in it yourself or a connected party live in the property, will suffer a charge. Everybody else, commercial letters, property developers, can claim a relief, but the relief has to be claimed and a return has to be filed. And even if there's no tax due, the revenue still has a very, very stringent fining and daily penalty regime. So if you think you're advising someone with a corporate, with a residential of value over 500,000, make sure they get up to date. Ignorance is no defence with HMRC, I'm afraid. Ignorance that your advisor, your broker, your lawyer should have told you about it is no defence. So that's one we see as really misunderstood. What else is coming? I'm beginning to sound like an accountant here. Record keeping is going to become very, very important. Making tax digital is now on the horizon. Every single business and every landlord will, somewhere, if not in 2020, certainly 2021, be expected to submit quarterly, up-to-date digital records to the revenue. So your spreadsheets, your little bits of pull it together 12 months later, people need to start thinking about digital software, lots of products out in the market like Xero and QuickBooks and Sage. You need to start thinking about keeping records digitally, keeping them up to date and in good order so you actually can comply with what's required. The biggest question we talked before, everyone's raised it, should I own it personally, should I own it in a company? Everybody goes, must be in a company now because I get full interest relief. It's not always the right solution. As both speakers said, it's about what's your longer term aims, what do you want? Do you want every pound of income out yourself? Are you going to sell the property? Do you need to get your hands on it? For most investors, both work for them in different situations, but I think you need to understand the differences. Sometimes just thinking about tax efficiency with husbands and wives and income levels, family ownership, trusts. There's a whole range of things that can be talked about and considered. So it's not always about just which is the right tax answer as well. It's about IHT planning, it's about the flexibility to do that. Certainly in companies, it's easy to give some passes of shares and keep control and parts of properties. So it's a more holistic view. And it's trying to get the balance right between what's the right tax decision now. We've already seen the tax rules change. We've got an election on the potentially next year. Who knows what those changes are going to be. You need to be in a flexible position where you can adapt and adjust your strategy for all of those and think about what you want long term. So the big question of the time is your existing portfolios. Should you incorporate? Should you actually take all those properties and throw them into a company? This is a really, really tricky situation. For some people, it will work, and for others, it won't. I think the thing everyone needs to understand is if you take your properties and you pass them into a company, tax charges are involved, and it's whether the reliefs that are available will apply. So the first impact is you have capital gains tax based on current market value. And so the relief that can apply is called incorporation relief. But incorporation relief can only apply if you operate a business, if the revenue accepts this is a business, that you actually do day-to-day management, that you run it like a business. Maybe you've got a partnership agreement. You've been submitting business returns, not just a page on your self-assessment saying, I've got a half of a share of a property. If it's a passive investment, this isn't even going to fly. And so maybe you have to change the way you manage. Maybe you need to plan for several years ahead to get into a position to be able to do this without capital gains tax. But it's really important that you look at, is this a business or not a business? The other thing, there's lots of lenders and lots of financiers here. The technicality of the rules say that to obtain this relief, you have to pass all your assets and all your liabilities over to the company. If you redeem your mortgage, take out a new mortgage in the company, and then pay off the old mortgages for the person passing in, that is not transferring the liability. That's giving consideration. So you might blow this relief. So you need to find a financer who can, if you've got borrowings, allow you to pass finance into the company. The other one, stamp duty land tax, that relies on partnership relief. So you must have been operating as a partnership for 3 years. If you're all connected parties, you're probably going to be okay. If it's clear you're only doing it for tax avoidance, you'll get caught. If you're not all connected parties, 3 friends or something, the rules can be quite complex and it may not happen. So do the numbers. So stay up to date, think about your ownership structure, and do the numbers on the incorporation. If anyone's got any questions, some of my team are here, we can answer them later. There's some leaflets around with our contact details on. Thank you very much.